Welcome to the Executive Innovation Show podcast, where we bring you real executive conversations with industry game changers and thought leaders. We ask the questions you're thinking, what you're scared to ask, and we make your brain hurt afterward. With your host, Carrie Chitsey, co-founder and CEO of One Touch Video Chat, live video interviews, and the nonprofit Humans Helping Humans.
Hello, everybody, and welcome to today's podcast. We have a great podcast for you today. We're going to be talking about venture capital and does seed or early stage still exist? We have gotten a ton of questions on this topic, and we've got two awesome guys here today to really talk through it. First, we have Mike Erwin, whose 30-year history and success of being a serial entrepreneur and also venture investing. He's the founder and chief investment officer of Ecliptic Capital, an Austin-based venture 2.0 fund targeting emergent investment opportunities, specializing being efficient execution, rapid scale, and outsizing value creation by increasing interconnected world. Mike, welcome to the show.
Hey, Carrie, thanks a lot. Good, great to be here.
Yeah, and then we've got Brett Andrews, who works at MicroVentures, a venture capital investment banking firm in Austin as well. His primary responsibilities include sourcing new investment deals, managing front-end due diligence, and negotiating term sheets, which we all hate. Just kidding, Brett. And prior to joining MicroVentures, he's a partner at Newgate Capital Partners, an angel investment M&A firm out of Orlando. Brett, welcome to the show.
Thanks for having me, Carrie. I'm really excited to be here.
Great. Well, I do have to comment, Mike, that you are keeping Austin weird with that cool shirt you have on today. So
Thank you. Thanks for noticing.
Well, so I want to set the stage of the podcast. We've got a lot of questions about does seed, early stage, pre-revenue, or Series A still exist? There's a lot of entrepreneurs that recently, and I don't know if it's, 2019 or when it really starts back to, that from the entrepreneur's perspective, they've built technology, and I'll use technology because we're all in the Austin town here, but they're past an MVP. They've got a working product. Maybe they have customers and they're looking for growth capital. They've tapped their family networks or their angel, their current investments, and they're really looking for that venture round to scale. But it seems like a lot of the conversations are the new kind of revenue threshold is that $1 million ARR, which is pretty rare that, a company kind of out of the gate is at that $1 million ARR. And there's a lot of unknowns in the venture capital world of some companies have that kind of minimum requirement, some don't. Websites are very misleading in the fact that it's kind of all across the board. So I just want to get you guys' take on, have you seen that change in the industry? What are you seeing for the deals that you're looking at? And is that really changed from that perspective? So Mike, I'm going to take that question to you first. What are you guys doing and seeing in the industry? And does that requirement exist for you guys? And has the industry changed? What's driving that?
Well, I think that venture capital has undergone some really massive change in the last 5 years.
Okay.
If you look, what we're seeing, the coasts have really moved to kind of mega funds, big deployments, and we've seen like a blossoming of entrepreneurial efforts across the world. However, companies, as they're growing through their life cycle, still seem to grow according to a certain pace. And because of that, regardless of what you call it, pre-seed, seed, ARR, and how much you need, companies still grow according to a certain rate. And because of that, they need help and capital at certain points along their lineage. So what we've seen is big capital providers needing to move into startups with bigger and bigger amounts of money because they have, $1 billion to put to work. And that amount of money is really hard to put to work unless you have a number of different companies that can actually put, 20, 30, $40 million to work. But seed stage companies, small ones like my fund actually focuses on, are at a business point in their life cycle where $1, $2, $3 million is really meaningful for them.
Right.
So our focus is not necessarily on, hey, how much revenue do you have coming into it? It's where you are in the business life cycle. And we believe that's a really fundamental look into venture capital as to how to grow a company and be successful, ultimately exit and get our LPs returns.
And what about you, Brett?
So I think similar to what Mike's saying about the large funds, I think some of the reason why there's been a dearth of capital for the kind of $500,000 check size, it comes from the sort of traditional 2 and 20 model of a fund, right? If you have a $100 million plus fund that you're putting to work, there's a certain amount of capital you've got to put into each deal, or else it doesn't work out. So in order to place all of that capital. So I think the funds that, from what I've seen at the very early stage, and early stage is a broad range, obviously. You could argue, companies at Series B are still very early stage in terms of the long-term life cycle. But I think the funds that we've seen have the most success in the, sort of almost quasi-angel stage are the ones that have a little bit of a different structure, whether that's the GPs actually being LPs in the fund, and so they're maybe taking less of a salary, and so the management fees of the fund are going towards paying their employees, or it could be they operate more like a family office where they're not stuck with a 10-year holding pattern and have to kind of cycle the fund out over a certain lifetime. So I think what you'll start to see in order to fill that gap, because there is still quality deals at the early stage, is different types of structures of fundraising. I don't know how Ecliptic is set up, but I know some other firms out there that are doing the kind of very early stage that are set up a little different than the standard 2 and 20.
Yeah, and so taking that kind of a step further, Mike, I know I've told you this before, but I love on your website the chart that you guys have about the investment stages, and having, staffing for this show, looking at so many venture capital websites. It was the only one I saw. So kudos to you of that. But it really went through the buckets of kind of where you guys invest, or where entrepreneurs to better understand the funnel. And you had the pre-seed at 50 to 250K, seed at 250 to $1 million, Series A 1 to 5, and B 10 to 50. Given that you guys come from being entrepreneurs, was there a reason that you put this chart on there? Because, the frustration, sitting on the entrepreneur side and, doing both sides of the coin is everybody says usually on their website that, they go across every facet, right? And everybody has basically said that, we don't want to miss out on, the next hoodie that's, going to be the unicorn, right? Yeah. But there's a lot of sifting through for not, if we were looking at any other industry, we were talking about like marketing messages, it would be like, well, that's a horrible marketing message because you're getting all these unqualified leads, right? So if we flipped it and we looked at the industry and any other vertical but venture, we would say that's a bad idea to have it on your website. So, Mike, what made you guys put that on the site and kind of put that out there? Because I think it's very, very great and helpful.
Well, we were really focused on where we provide the most value. Our fund is an operational excellence fund. So I'm a business operator. My folks are business operators. The whole team is really focused on scaling businesses. That's ultimately what venture capital is about, or any investing in seed or early stage companies is about making a company work, getting value created, having that value grow, and then ultimately realizing returns on your investment. So there needs to be a really lock sync in between the entrepreneur, the founder. Many investors have lost sight of the actual fundamentals of value creation. And that's really where the rubber meets the road. And so we put the chart up there really to indicate to not only our LP community, but also our startup community, hey, we see you through this lens. we see you growing a business, and we hope that you understand that there are certain stages of business development. You know, there's this early stage where you're figuring it out and you're trying to get some early customers, and you're getting product market fit, and maybe you're getting a little traction, you got a few customers. And then as you develop that, you have to shift your focus from creation and invention and advancement to business build. And that's really what's exciting to us. We're looking for those entrepreneurs that have figured enough out their stuff to really refocus onto, oh gosh, it's working. We have 10 customers and each one has paid $1,000, and now we need to scale up. Those fundamental, abilities that the founder has early for creation are starting to turn into business management. And those are sometimes different people, or a shift in thinking for the people that are founders. So we're trying to draw out what capital requirements are kind of through the growth phases of a operational scaling business, which is where we provide the most value.
That's great. And Brett, as we went through kind of those 4 buckets using the ones I just gave, where, since you're kind of on the front lines of deal sourcing and so forth, where are you kind of seeing the most tractions from those buckets, and where are you guys playing?
Yeah, so we actually don't have like specific ARR requirements. Just for the people listening or watching that don't know much about MicroVentures, we're sort of a quasi investment bank, quasi venture capital firm. So we've got basically 3 ways that we either raise or invest capital. We have some relatively small verticalized funds. So currently we're investing out of a blockchain fund and a cannabis tech fund. But the bulk of the capital that we raise is through syndicates, through an accredited investor network that we've built over the years. So, and then I guess the last platform is we do have a public equity crowdfunding platform that we actually don't monetize directly, but it's sort of a deal flow generator for us. So as you look at the buckets that you mentioned, I would say typically if you're looking at the pre-seed to seed, for us it's generally more of a fit on the public side of the platform. So we're helping to provide some capital at no cost outside of what equity is sold to that investor group that the company can hopefully use to grow into a level that we can participate on the private side, which I would say is sort of pre-Series A and beyond. Again, because of the way that we're set up, we don't have a set requirement on where that specific company
right
in order to fit which side of the platform, but I would say that that's generally how it's split up.
Okay.
Yep.
And so, Mike, coming from the entrepreneur side, there's a lot of sifting through if you're going to raise money. I always say, it's very much like a marriage, and, both sides have to really want to be in this, and know that there's going to be trials and tribulations, and, something's going to go wrong in the business, and venture's going to get mad, and it's back and forth, right? It's a long-term deal. It's a journey. It's not a sprint. And so finding the right partner, the right venture partner, can sometimes be a struggle for an entrepreneur, because you get in, you've done so many pitches and you're just worn down, and so when you do get somebody that's interested, it's kind of like you're at the 5-yard line and you're so kind of worn down, you don't pay attention a lot of times to is it truly the right partner, right? So yeah. What advice do you have to entrepreneurs on really how to find the right venture partner? Because on the surface, a lot of people look the same. What's your advice? I know you and, your partner, Worley, obviously I've known for a very long time. You guys have raised money with your own companies, and now you guys are on the other side of the coin. So stepping back a little bit, what advice do you have for entrepreneurs that are raising or looking to raise to find the right partner?
Sure. Probably the most important thing is, when you're talking to a potential investor, understand that you as an entrepreneur are creating an opportunity for them. So you're looking for a partner. You're looking for a community of interest. You're looking for, harmony. You're looking for the right fit from a human connection. And that was where I was referring a little earlier to how venture capital has maybe moved away from what I call value creation, which is where not only the best returns are, but the best fit between the entrepreneur and the capital provider is really related to, we really are spending the time. You are really giving us transparency. We're giving you transparency. We're partners together in this. So you're right. We, as an entrepreneur, I view it as my firm Ecliptic is really entrepreneurs investing in entrepreneurs. So we go through a long cycle, really understanding what the whole business length, and we select those that really are fit for scalable business. So many things haven't turned into a business yet. They're still experimenting. And those that are on the verge of turning into a scalable business are good fits for us. But often we spend 6 to 12 months with companies before we deploy capital. And that's a shift away from what we see in the market. Venture capital is moving to faster and faster deals, larger and larger deployment amounts, to the point where, you hear these terms like seed is the new A, is the new B, blah, blah, blah. Really, the companies haven't changed. When you look at a startup company and they're 3 guys in a garage with the thing they built,
yeah,
do they need $25 million and do they need to hire 100 people? Probably not. They need to get to the next business milestones that really matter. So we connect really well with entrepreneurs because we know we've been through it ourselves. We know exactly what it takes to succeed. That's what we're looking for. And so what I would encourage is, as an entrepreneur, really understand how the capital is going to help you outside of the capital. Yes, they're going to come with money. That's terrific. If you solely focus on money, you're going to have someone that's solely focused on money.
That's what I always say. It's such a recipe for disaster. If it's not strategic investment, it's probably not a good investment. Yeah. And so, Brett, on your side, so you're, on the front line kind of deal sourcing. Let's flip the coin here a little bit. What do you look for from an entrepreneur or a founder to say, hey, this company makes sense to kind of get through the front lines and for us to kind of take a little bit different look? What are some of those kind of key ingredients that make up kind of a deal that flags your interest?
Yeah, so similarly to what Mike was just talking about, coming from the other direction, I think for us, everything starts with team. Our goal and our whole strategy is to find founders that we can continue to fund as they grow, right? So it's better from us from a business model perspective. It's more enjoyable. We want to find people that we want to work with and that we can help grow along the way. So obviously there's that sort of connection. Is this somebody that I enjoy working with? And there's industry expertise, or are they bringing some level of experience, from the industry, or something unique that I think would enable them to have a competitive advantage from a team standpoint. Yep. And then within the founder group, how do they interact with each other? What's the different skill sets that they might have? How do they behave interpersonally with each other? Have they been friends for a long time? I think all those things are really important when we're looking at the team. Then, in the very early stage, it's, are you uniquely solving a problem that really exists? I think we see a lot of companies that are building solutions for problems that either maybe they're just not there yet, or they're not that big of a problem. And I think if it's not that big of a problem, it's going to be very hard to sell the solution, right? So that's one thing that we look. I mean, some people might call that product market fit. That's another component that we look for. And then lastly, just trying to understand some metrics. So this really depends on the type of business that it is. I mean, we're industry agnostic, so it varies a lot. But if we're looking at a consumer SaaS platform, then things like customer acquisition costs, lifetime value, churn rate, those sort of metrics are important for us. If it's more of an enterprise SaaS, then sales cycle, what's your customer concentration, the revenue model. I think all of those things are important, but it all starts with who it is that's running the business.
Right.
Yep.
Good. And Mike, what are your kind of top 3 things when you're looking, whether it's at a deal or at a company? What are the 3 things that are kind of your, I don't really call them deal breakers, because I know your guys are a little bit different and we'll probably say that's different, but what are the 3 things that, again, looking at whether they're company metrics or whether they're team metrics, that say, hey, we should take a look, given that you are spending a good amount of time with this company than most?
Well, you're right. Our model is definitely very different. It's a very high touch model. It's really focused on ultimate business outcomes. And what we do, just to kind of describe the process a little bit, because I think it will reveal the answers, is we have a large amount of deal flow. So there's a lot of stuff that we're actually interacting with, but we're selecting for those things and talking with entrepreneurs about who's going to be needing to deploy capital and, like in the next 6 to 12 months or so. And what we do for those deals that actually fit with our thesis, the metrics of success before a company actually has financials. So we tend to focus on right at first revenues to break even point. That's like a window of business growth, a business of a window of time that we're really interested in participating in. We believe that that's one of the biggest areas of value creation is right during that window. So we like to get involved early and actually have some communication and see what's going on. And what we do is develop some metrics of success with the founders. And those could be things that are, let's call them business milestones, and they're not necessarily grow revenue from A to A+3 or something like it. Early, when a company is developing or scale to 1,000 users, get one to convert into paying customer. So what we do is really focus on business critical milestones. And so that's one of the critical areas that we have with our founders is to set what those look like. And what we're really gauging is ability to execute. Do the founders have a reasonable view of what the business growth aspects look like and what they can accomplish along the way? Those things really reveal to us the team's ability to execute, which is like the central focus around like all venture capital generally is can the team execute? The best indicator there is the team has executed before, but what we're seeing is there's so much value creation worldwide right now in a bunch of different markets other than kind of the primary coastal markets.
Yeah.
Those are necessarily first-time entrepreneurs. And the only way to see if they succeed and can execute on what their vision is you participate, watching them and helping them develop metrics and say, oh, that customer may not understand your business protocol, so let's help you with that. And we really kind of get down and dirty into that growth phase with them and help them really focus on what the business metrics are. And that's what reveals the investment for us is when they're moving really fast and accelerating, that makes time, that's the time for us really to start working at term sheet and actually get capital deployed.
No, that makes sense. And there's been a lot of debate of when is the right time for a company to raise, right? And I think everybody kind of has a little bit different of opinion. But Brett, when do you think is the right time for a company to raise? And I want to preface it by saying a lot of people get irritated with the canned emails from venture that is, hey, we love this, we love that. Keep us informed, communicate, it's not the right, the company's not there yet, or, doesn't have enough either, revenue or the traction email or whatever. I hear about them all the time. So putting your venture hat on for a second, those emails are typically, hey, you shouldn't be raising venture yet, or, basically is the net, or they're not interested depending upon the deal. But when do you think is the right time? When should a company be wanting to raise and venture versus staying in the path that they actually need a larger amount for that scale? What are your thoughts, Brett?
Well, this might not be the answer that you want, but I think it completely just varies across the board. I mean, to me, there's no standard response to that, and I think if I were to try to give you one, it wouldn't be honest. So I think it really depends. I mean, there's some experienced founders that have gone through a couple iterations and had different successes that might be able to go in and raise, and they know they already have a plan set, they know how to execute, and they can go in potentially and raise money right away and be off to the races. I think if it is your first time, sort of what Mike was walking through, I think building sort of your track record of being able to take something from point A to point B, no matter how far away that is, and show that something is working there, I think is important. And also, what is the capital for? Mike mentioned earlier, raising, there's a lot of companies, I see this often, that raise far too much capital when they don't need it. And either they end up overvaluing the company way too early, and they've got this pressure to grow into it, or they end up giving up far too much of the company because they raise more capital than they needed. So I think really starting with that use of funds and what do we need to put this into is really important.
Yeah, I think that's a great point. I think, I see that, with a lot of inexperienced, companies that have a great idea, and they think the value of their company is based on how much their press release says that they can raise. And then they don't realize that they've shot themselves in the foot for their Series B, and their investors are going to be pissed with the down round. So I think that when I read that, I'm like, okay, first-time founders all the time. Mike, when do you think, do you agree? Do you disagree? When do you think it's the right time for a company to kind of migrate from maybe an angel to now I need to get some venture involved in here?
Don't focus on the money. Focus on the success. You're building something. You're creating something. You have a vision for something. As an entrepreneur, if you start focusing on what round am I, which money, if you're focused on the money, you're going to lose sight of the thing that is what is value creation. The thing that attracts your investor to you is the development of something new that is marketable and grows. And, that losing track of that is what I see is a big mistake, because if you're spending a lot of time really going and rebuilding your deck and really trying to get better answers to how big your market is, and working that spreadsheet, infinitely out to the 5th and 7th and 20th year, forget it. Nope, that doesn't matter. You really need to prove that you're accomplishing it in a short period of time. Like, what matters to an investor is 3, 6, 12 months, certainly, maybe into the second year. But if you demonstrate that you're creating value in a short time frame, and that is critical to an investor, they're going to want to invest. They're going to want to give you a term sheet. They're going to want to talk about participating.
Yeah. No, I think that's good. So, well, it's been great. Some good topics here. The last thing we always ask on the show is what's keeping you up at night as an investor. And so, Brett, outside of, wives, husbands, kids, all the personal things, what's keeping you up at night or two things that are keeping you up at night as an investor?
Yeah, so I'll kind of focus on the post-funding items. So I think the first would be budgeting. So I think, startups fail for a lot of different reasons, but ultimately it's because they run out of cash. And so raising capital is a big portion of that, which we've talked about a lot today. But I think also managing that cash flow once you have the capital is extremely important. I see a lot of companies, understandably so, are a little weak in the CFO department in the very, very early stage. And so setting up some policies and procedures to know how and when you're going to, how you're going to manage your cash flow, I think is important. And forecasting and setting a budget for the year, I think is massively important. And then I think the other is communication with investors. So again, especially in the very early stage, MicroVentures isn't as involved post-funding as my last firm, but certainly in my last company, we were very hands-on, and there's many times I would have, maybe not many, handful of times I'd have founders call me, go dark for a period of time, and then call me a month before they're about to run out of capital, and there's nothing that you can do at that point. So I think similarly, setting up some procedures on when you're going to update your investors and making sure that you deliver the bad news as well as the good news. I think anybody who's doing this professionally understands the risks that are involved. But back to the partnership that we've been talking about before, that you need to look at your investors with. I think you need to keep them updated on what's going on. And so it's that transparency that Mike mentioned as well. I think it's hugely important. So.
Yeah. Good. And what are your two things, Mike?
I think both things are the same. I think I am really concerned about the public markets and the coming, I'm going to call it economic storm. I think what we have is, I think there's a departure of reality with respect to how the public capital markets are working right now. So what keeps me up at night is kind of what's going to happen to the great advance of society has made during these bull runs that we've had. And I'm worried about impacts across the world with bear market conditions and what investors and what may happen to the value creation. Now, I will say, as a positive point, early investing, seed investing, and venture capital are often not correlated with public markets. So I think it's a really great time right now to be involved in helping startups get going, because I think what's going to happen is you're going to see the coming wave of new advancements, since it's really easy for someone to start a company right now and have big public tools for actually building something. So I'm afraid that the public markets are going to go kind of south, but I also am really hopeful that a lot of people are going to get their start during this next couple of years.
Great. Well, I want to thank you guys both for being on the show. It has been a pleasure. Click in the show notes to follow either Mike or Brett in their journeys and their venture companies, what they're up to. If you have any questions, feel free to submit those. I'll happily get the answers from either of them for you. Feel free to subscribe, get your weekly podcast of the Executive Innovation Show. Today's podcast is brought to you by One Touch Video Chat, live video interviews, and One Touch Telehealth. Guys, thanks so much for being on the show. I really appreciate it. Great insights.
Thank you, Carrie. This was great.
You bet. Thanks, Carrie. Really appreciate it.
Thanks, guys.